Households contribute factors of production to the firms. Firms in exchange give them money, which is called factor payments. These factor payments become the income of the households, which they either spend or some part of it they may save. Why does trade and services go under the invisibles account? Because services are intangible. Current account balance here would be what? It would be as simple as A plus B. Balance on the visibles account plus balance on the invisibles account. This year, the economy received less compared to what it had to pay to the rest of the world. The price is not being decided on the basis of demand and supply, but on the basis of authority. This is our last and final video in our series on NCERT necessary for UPSC preparation. This chapter will be around open economy macroeconomics. There is a couple of things which are there in the class 12th NCERT here that we have to talk about. One thing we'll have to talk about is what is called balance of payments. And the other thing that we'll have to talk about is going to be exchange rates. So let's start our discussion. Firstly, when we speak about open economy macroeconomics, what is meant by an open economy? Remember, we discussed some bit about the circular flow. We said that any economy will have the following agents. They will have households. Any economy will have firms. Any economy also has what is called its financial markets, as well as its government. Each of these agents has a specific role to perform. Households contribute factors of production to the firms. Firms in exchange give them money, which is called factor payments. These factor payments become the income of the households, which they either spend, becoming their expenditure, or some part of it they may save. The savings are routed through the financial market, and the financial market will give these savings either to the firms, back to the households, or to the government, either in the form of loans or in the form of investments. Similarly, the task of the government is to perform the necessary functions which will not be performed by the market, the most important of which is public provisioning. Now, the government also requires factors of production which come from the households, and the government gives them compensation. The government buys goods and services from the market. The government makes an expenditure which is called government expenditure. The government also taxes both the households as well as the firms. This is exactly what happens in any economy. There will be three major agents: households, firms, and the government. When this economy in its simplistic model does not interact with the rest of the world, we call this economy a closed economy. But when this economy interacts with the rest of the world, that is when we call an economy an open economy. So we can have another sector here which we will call the external sector, or I can also call this the rest of the world. What will this external sector include? Different countries will have their own households, will have their own firms, will have their own governments. You can think, for example, in the US, there will be consumers in the US, there will be the US government, there will be firms in the US. You think about UK, you think about Germany, you think about Japan, you think about Bangladesh, you think about Sri Lanka. Every economy will have these three agents. And when our economy interacts with the rest of the world, taken together, this is when the economy becomes what is called an open economy. Now, what kind of an interaction can a closed economy have with the rest of the world? The transactions between any economy and the rest of the world can primarily be around trade. They can be around transfers. They can be around borrowings. investments, or the flow of what is called the banking capital. You think of any transaction which can happen between India and any other country, you will be able to place that transaction in any one of these five heads. It could either be a trade related transaction, it could be a transaction with respect to transfers, it could be a transaction with respect to borrowings, or with respect to investments, or with respect to the exchange of banking capital. When an economy interacts with the rest of the world, we always maintain a systematic account of all economic transactions happening between one country and the rest of the world. A systematic account or a systematic record of all economic transactions between an economy and the rest of the world. This record, this systematic account, is what we call the balance of payments. It is as simple as that. Much like the government comes out with its own annual financial statement, which is what we also popularly call budget, every time one nation interacts with the rest of the world, and this interaction is economic in nature, we maintain a systematic record of all of these transactions between a country and the rest of the world. This record is what we call the balance of payments. Under the new IMF classification, the balance of payments contains two major components. Either a transaction can be recorded under what we call the current account, or a transaction can be recorded under what is called the capital account. Meaning that whenever a nation interacts economically with the rest of the world, this transaction can either be classified as a current account transaction or it can be classified as a capital account transaction. Now, what is the difference between the two? The capital account transaction here is exactly the same as the capital head under the budget component, which means that any such transaction which will have an impact on the assets or the liabilities of an economy. And keep in mind, this is very important, any such transaction which can change the assets, which can change the liabilities of an economy, not the government alone, but the entire economy, that is what is called a capital account transaction. And when we say change in assets and change in liabilities, it can either mean an increase in the assets of an economy or a decrease in the assets of an economy. Similarly, change in liabilities here would mean any increase in liabilities or any decrease in the liabilities of an economy, not just the government as well as private parties. These transactions will be called capital account transactions, which means that the residual transactions, all such transactions which have no impact on the asset liability structure of an economy, they will be a part of your current account. Meaning, such transactions which do not impact the asset or the liability structure of an economy, we will classify them where? Under the current account. Now we will open up both of these accounts individually. The current account can broadly be classified under two heads. One is called the visibles account and the other one is called the invisibles account. Similarly, capital account transactions broadly include three things. One is investments. The second is what you may want to call banking capital. And the third is what you call borrowings. Broadly speaking, any current account transaction can either go under the visibles head or the invisibles head. Similarly, Any capital account transaction between an economy and the rest of the world can go either as a part of investments or an exchange of banking capital or borrowings. Now, let us talk about the visibles account. What is included in the visibles account? When an economy trades in goods with another economy, that part goes under the visibles head. It is very commonsensical to understand as to why this will be called the visibles head. It is because goods are tangible, they are storable, they are transferable, and you can see the trade happening in goods, which is why the trade in goods always goes under the visibles head. And when we say trade in goods, what does this mean? It could mean export of goods. It could even mean import of goods. When an economy sells goods to the rest of the world, or when an economy buys goods from the rest of the world, both of them will be included under the visibles head under the trade in goods. This is also what you call merchandise trade. Keep in mind that when you are selling your goods to the rest of the world, you will earn some money, which is why these type of transactions will involve a net inflow of funds. Similarly, when you are buying goods from the rest of the world, this will mean that an economy has to spend money. This would lead to an outflow of funds and hence is recorded in negatives. Similarly, what will come under the invisibles account? Invisibles account will include, broadly speaking, two things. One is what you call trade in services. The other one is what you will call transfers. Now, trade in services. Why does trade in services go under the invisibles account? Because services are intangible. They are economic activities. These are not physical objects. All services are economic activities which have utility for somebody. Services are consumed the moment they are produced. They are intangible. You cannot store them. So you cannot witness trade in services happening really, which is why trade in services is going to go under the invisibles account. This is going to include both the export of services as well as the import of services. Once again, if you are exporting services, this is going to lead to an inflow of funds into an economy. And if you are importing certain services, this is going to lead to an outflow of funds from an economy. Now, what gets included under the transfers? Remember, we have discussed this previously also. Transfers or transfer payments are a specific type of economic transaction where funds flow from one party and are received by another party, but the party which is receiving these funds has no reciprocal obligation to give something back to the party sending these funds. These are unilateral transfers. So what will be included here? You can talk about gifts, aid, grants, donations, remittances. These are what you typically call transfer payments. For example, what is a remittance? A remittance is, consider that your brother, let's say, is living abroad. He wants to study abroad, so he receives or he requires some money to be sent. Your parents will be sending money from India to this person, to your brother, let's say he is living in the US. This is a unilateral transfer of money because your parents sent money to your brother. Your brother does not have to send something back to your parents. This type of a unilateral transfer happening privately is going to be called a remittance. Now, when you look at it closely, trade in goods does not create any assets, does not reduce any assets. It does not create any obligation, any liability. It does not reduce any liability either. Similarly, trade in services, any export or any import of services is not increasing your assets. It's not decreasing your assets. It is not increasing your liabilities or decreasing your liabilities. Same is the case with transfers. Therefore, these transactions will be categorized under the current account. Those transactions which have no impact on the asset liability structure of an economy. Now, what goes under the capital account? Capital account, first thing, will include what is called investments. Now, investments can be two-sided. You can have your normal residents investing their money abroad. Similarly, you may have foreigners investing their money in India. One is called offshore investments. What are offshore investments? This is where domestic residents are investing money abroad in the rest of the world. Similarly, when your economy receives investments from the rest of the world, that is what is called foreign investments. Once again, if your residents are making investments abroad, this would mean that there is an outflow of funds from this economy. Similarly, if foreigners are making investments in India, this would mean that there is an inflow of funds into your economy. Another part is what is called banking capital. Now, what is meant by banking capital or net banking capital? You may have your domestic residents who want to open up bank accounts abroad. Similarly, foreigners, non-residents, they may want to open up their bank accounts in India. The difference between the two, the difference between non-resident deposits in India versus domestic resident deposits abroad, that is what is called net banking capital. You can talk about non-resident deposits. Now keep in mind that there are three types of accounts that we allow, or our banks allow foreigners to open in India. One is called non-resident ordinary account. The other one is called non-resident external account. And the third one is what is called foreign currency non-resident account. Now apply your mind and think, what is going to happen if a non-resident opens a bank account in India? Let us say any foreigner opens a non-resident external account with HDFC Bank in India. Will that be registered in the balance of payments? Take your time, think about it. The answer is yes. Why? Because this is an economic transaction. Secondly, it's a transaction that is happening between one nation and the rest of the world. A private individual in the US wants to open a bank deposit in India. So there is an economic transaction happening between two nations. Secondly, what kind of a transaction is this? Remember that deposits are liabilities on banks. That means banks will have to pay this money back alongside interest. Therefore, any non-resident opening a bank deposit in India is creating liabilities on our domestic banking system. Similarly, when our residents open bank accounts abroad, those banks are taking liabilities onto themselves. Since it impacts the liability structure of an economy, therefore this type of a transaction will be included under the capital head. Net banking capital, keep in mind, means domestic residents opening bank accounts in the rest of the world, and it is also going to include non-residents opening bank accounts here in India. Third part is borrowings. Now, borrowings, once again, are liabilities. Borrowings create liabilities because borrowing has to be returned back alongside interest. Now, borrowings, since they impact the liability structure of an economy, therefore, borrowings will be included under the capital head. What kind of borrowings will we include? We will include government borrowings. We will include borrowings by commercial entities, or you may want to say non-governmental borrowings, private borrowings. You may have government borrowings or private borrowings. Government borrowings happening from the rest of the world is going to be a part of India's external debt. However, it will be one part of India's external debt. This is going to be called sovereign external debt. This is debt taken from external sources by our governments. These could be central government, this could even be state governments. Since the government is taking a liability onto itself from external sources, therefore, one, that this is external debt, yes, and this is sovereign external debt, debt taken by the government. Similarly, commercial entities, private entities, they can also borrow money from abroad, or non-residents can also borrow money from India. When private entities borrow money from abroad, this is what is called external commercial borrowings. This could be commercial borrowings done by foreign residents from India. This would also include commercial borrowings done by domestic residents from abroad. Keep in mind, the balance of payment is a record of both types of transactions involving inflow of funds as well as outflow of funds. When we talk about trade, we are not counting only the things that we sell to the rest of the world. We will also include things that we buy from the rest of the world. Similarly, when we are talking about trade in services, we are talking not just of the services that we sell to the rest of the world, we are also talking about the services that we buy from the rest of the world. When we talk about transfers, we are not talking only of the transfers sent by the economy to the rest of the world, we are also talking about the transfers received by the economy from the rest of the world. Come down to the capital head. Once again, investments include both types of investments. Investments done by domestic residents abroad. Similarly, investments done by foreign residents in India. When we talk about net banking capital, the word here is net. That means banking capital received by the economy, banking capital that has outflown from this economy also. When we are talking about borrowings, it's not just the borrowings that we have taken, it's also the borrowings that we have given. All of these transactions can either come as part of the current account or the capital account. I hope this is clear. Both of these transactions are included in a nation's balance of payments. The key word, and a lot of people make mistakes here, is keep in mind that this is not like the budget. The budget is a statement for the government only. But when we are talking about the balance of payments, it is a statement for the entire economy. That means it of course is going to include the government, but also all other private entities, right? Now, let us chart the balance of payments down as to how it is presented normally. The first head will be what you may want to call balance on the visibles account. What will visibles account include? Visibles account is going to include export of goods, and it is also going to include import of goods. This is also called merchandise trade. These are the components of the visibles account. But when you are saying balance on the visibles account will always be the export of goods by value minus the import of goods by value. The second part will include what is called the invisibles account. And invisibles account includes two things we have spoken of. One, it is going to include trade in services. That means it is of course going to include the export of services, and it is also going to include what is called current transfer receipts. Both of these will lead to an inflow of funds into an economy. Much like the export of goods is going to lead to an inflow of funds in an economy, similarly export of services, current transfer receipts, what you have received, this is going to lead to a net inflow of funds in the economy. This minus the import of services and current transfer payments. Import of services means that you are buying services from the rest of the world. That means you will have to spend money. This is going to lead to an outflow of funds. Similarly, current transfer payments, when you are sending remittances abroad, when you are giving donations abroad, when you are sending gifts abroad, when you are giving aid to the rest of the world, all of this is going to lead to an outflow of funds and hence is going to be included here. Balance on the invisibles account is going to include the export of services plus current transfer receipts minus import of services plus current transfer payments. Now, the third head will be what is called the current account balance. And what will current account balance be? It's very simple. Now that you have understood it pictorially, current account includes two things, visibles account and invisibles account. Therefore, current account balance here would be what? It would be as simple as A plus B. A plus B. Balance on the visibles account plus balance on the invisibles account. So can I write it down like export of goods and services? This is going to lead to a net inflow of funds plus current transfer receipts. Since you are receiving this money, this is going to lead to a net inflow of funds. Export of goods plus export of services, export of goods and services, current transfer receipts, minus import of goods and services, import of goods plus import of services, plus current transfer payments. Both of these are going to lead to a net outflow of funds. A plus B gives you current account balance. The next head would be what is called capital account balance. And what will capital account balance be? This would be very simply put, capital receipts minus capital payments. What will capital receipts include? How is India or the economy receiving capital? This could be receiving capital in the form of foreign investments, so foreign investments coming in. Similarly, non-residents making deposits in India, this is you receiving money. Similarly, the government receiving debt from the rest of the world or commercial entities receiving debt from the rest of the world. These will be capital receipts. Capital receipts are what is going to lead to an inflow of funds into an economy. What will capital payments include? Capital payments will of course include when your domestic residents want to make investments abroad, so offshore investments, or foreigners want to withdraw their investments from the economy. Similarly, when your domestic residents want to open deposits in the rest of the world, or when the non-residents want to withdraw their money from banks here in India. Similarly, when the government has to pay back this money, or private parties in India when they have to pay back their loans, or when they are giving loans to the rest of the world. This is going to be included as part of capital payments, and capital payments is going to lead to an outflow of funds. The next part here is what is called errors and omissions. Now, errors and omissions means what? Keep in mind that India follows what is called a double entry bookkeeping system. It is an accounting practice. What this means is that we will have an official record of a transaction and we will have an actual record of a transaction. For instance, when you are, let's say, selling your goods, you want to export shirts to UK. At the port, the customs authorities are going to ask of you what is the value of these items. Let us say the value of your items was 1,000 pounds. We will register this in the negatives. This will be the official record. Right? When you sell these goods abroad, maybe that you did not receive 1,000 pounds, you actually received 990 pounds. So when you receive 990 pounds, we will record this as positive. This is the actual record, which means the authorities, when they registered it officially, they registered the value as 1,000 pounds, but what was received against it was actually 990 pounds. Therefore, there is an error in the official record. You add both of these, you will get minus 10 pounds. This is the error. And the error and omissions can be across the capital account, they can be across the current account. So the next entry is called the errors and omissions. Finally, what you have is what is called the overall balance of payments. Overall balance of payments. And what will overall balance of payments include? It's very simple now. It is going to include the current account balance plus the capital account balance plus errors and omissions. This will always be C plus D plus E. C means current account balance, D means capital account balance, and E means errors and omissions. Or we can talk about this like, we can say it is going to include exports of goods and services plus current transfer receipts plus capital receipts. This and this minus import of goods and services plus current transfer payments plus capital payments. This is what is going to be called the overall balance of payments. We can take a scenario where we can talk about what is meant by a BOP surplus, BOP equilibrium, or a BOP deficit. Consider a scenario where the export of goods that happened in this year, let us say, was 100 billion US dollars. By value, we exported 100 billion US dollars worth of goods. We also imported goods, and we imported, let us say, 150 billion US dollars worth of goods. For example, India's major import heads will include gold, this will include crude oil. This year, we imported goods worth 150 billion dollars, while we exported goods worth 100 billion US dollars. This would mean that what is happening in the visibles account balance, also called the trade account balance, in the trade account balance, we have $100 billion minus $150 billion. We have a deficit of 50 billion US dollars. Whenever this value is negative, this will be called a deficit. On the trade account, we have a deficit, meaning that this year, $50 billion left the open economy, left the economy because of trade in goods. Similarly, under the invisibles head, since we export a lot of our services, let us say we exported services worth 300 billion US dollars, and we received, India is one of the highest recipients of remittances from the rest of the world. It has crossed $130 billion. Let us say we received $150 billion as current transfer receipts. We also imported services. Let us say we imported services worth 100 billion US dollars, while we had to send money abroad in the form of current transfer payments, and let us say we sent $100 billion abroad also as part of current transfer payments. Then on the invisibles account, what do we have? We have a 300 plus 150 is a 450. 450 billion US dollars minus $200 billion. This means we have a surplus of a 250 billion US dollars. That means owing to trade in services or current transfers between India and the rest of the world, this year there is a net inflow of funds. How much? 250 billion US dollars. Therefore, what will the current account balance be overall? This would be A plus B. This should be minus 50 plus 250. That means on the current account, we have a surplus of 200 billion US dollars. Let us say this year we did not receive a lot of investments. This year a lot of investments had to be paid back. Let us say the capital receipts this year was 300 billion US dollars, while capital payments this year were, let us say, 500 billion US dollars. It can either be because domestic residents wanted to make a lot of investments abroad. For example, Tata bought JLR, or Reliance bought another foreign company, or the government thought of investing abroad. This could be because of that. This could be because of the economic conditions which were not looking very great. So a lot of foreign investments in the economy, they were withdrawn. That can also happen. Because of any reason, the capital payment may be higher than the capital receipts. This means that on the capital account, we have a deficit of how much? 300 minus 500. We have a deficit of 200 billion US dollars. Whenever the outflow is more than the inflow, this is a situation of a deficit. Whenever the inflow is more than the outflow, we have a situation of a surplus. Whenever the inflow and outflow balance each other out, that is a scenario of an equilibrium. In the overall balance of payments, let us say there are no errors and omissions. Therefore, the overall balance of payments will include what all? It will include export of goods, $100 billion, plus export of services, $300 billion, plus current transfer receipts, $150 billion, plus $300 billion, which is capital receipts. This could be 100, 400, 550, and $850 billion minus $150 billion plus $100 billion, 250, plus 100 is 350, plus 500 is 850. Yeah, 150, 200, 350, 350 plus 500 is $850 billion. That means in the overall balance of payments, you have $850 billion minus $850 billion. You have a zero here. This means in this year, the economy received as much foreign exchange as it had to pay back. This scenario is called an equilibrium scenario. This means our payment obligations were balanced by our incoming. You can also do this way. You can say this is C plus D plus E. That means current account, we have a surplus of a $200 billion. Capital account, we have a deficit of a $200 billion. That means this plus this is going to be zero, and errors and omissions were zero. This would mean we have an equilibrium on the overall balance of payments. It is as simple as it gets, nothing more than this. Now keep in mind that all of these transactions are also what is called autonomous transactions. Why do we call them autonomous or independent transactions? We call them autonomous transactions. There is only one reason behind this, and the reason is that whenever these transactions are happening, whoever is engaged in these transactions does not care or does not worry about what is going to happen to the overall balance of payments at the end of the year. If you want to send a gift to your sister in the UK, do you worry about what is going to be the state of the balance of payments of India at the end of the year? I doubt you will. Similarly, when let's say any domestic company is receiving foreign investments, does it care about what is going to happen to the overall balance of payments at the end of the year? When Tata wants to buy JLR in the UK, does it care about what is going to happen to the overall balance of payments across the year? All of these transactions are done independently, autonomously of what is going to happen to the overall balance of payments at the end of the year. Therefore, these are called autonomous transactions. And if I could draw a dotted line here, I can call the left side of the dotted line, this I can call autonomous receipts, because this is us receiving money. And on the right side of this dotted line, I can call them autonomous payments, because this is money that has to flow out of this economy. If I have to define a BOP surplus, a BOP deficit, or a BOP equilibrium, I can define it in one more way also. A BOP surplus is a situation where an economy receives more, where the autonomous receipts are greater than this economy's autonomous payments. That means this year the economy received more than it had to pay. A BOP deficit will be the exact opposite. This means when an economy's autonomous receipts are less than its autonomous payments. This year, the economy received less compared to what it had to pay to the rest of the world. And a BOP equilibrium will simply be a scenario where an economy's autonomous receipts are equal to its autonomous payments. That means the economy received as much money from the rest of the world as it had to pay back. There is no change to the reserves of this economy. This is also how you can define a BOP surplus, a BOP deficit, or an equilibrium. Remember, surplus would only be when you are receiving more than you have to pay. A deficit would be when you have to pay more than you are receiving. And an equilibrium will be when you are receiving as much as you have to pay back. Below this dotted line, there is one more entry. This entry is what is called reserve movement. And what is reserve movement going to be? If, let us say, we had a BOP surplus, if this year the economy received more than it had to pay back, the RBI, who is the custodian of forex reserves in the economy, is going to buy that extra forex and build reserves with it. Since this year, in our example, the economy received as much as it had to pay, there will be no change in the reserve movement. Consider a scenario, let us say, if the capital payments, let us say the capital payments were not $500 billion, let us say the capital payments were $100 billion. In which case, we would also have a surplus on the balance of payments. We would have 300 minus 100. We will have a surplus of $200 billion. That means on the overall balance of payments, we would have a surplus of $400 billion, 200 plus 200. These extra dollars will be bought by the RBI and the RBI is going to build reserves with it. Keep in mind that the symbol used with reserve movement is the exact opposite of what the overall state of the balance of payments is. If you have an overall balance of payments surplus, reserve movement will be recorded in negative. If you had a BOP deficit, reserves will have to be used to make that payment and reserve movement will be shown in the positive. This confuses aspirants a lot. The sign of reserve movement is exactly the opposite of the sign of the overall balance of payments. I hope things are clear to you now. What is the balance of payments? It is simply a systematic record of all economic transactions between an economy, which means the government and private parties, with the rest of the world. Any transaction can broadly be classified under these two heads, the current account as well as the capital account. The current account can further be divided into the visibles account as well as the invisibles account. So all of you who are making your notes, if you remember this schema, you will be very easily able to place and solve almost all of your prelims based questions coming from this chapter. Similarly, the capital accounts will have investments, it will have banking capital, it will also have borrowings. Keep in mind, we are talking about an exchange between an economy and the rest of the world. So it's not going to be only those transactions which help an economy earn more. It will also be an economy spending its money. So you will record in trade in goods, you will record both exports and imports. Similarly, trade in services, both exports and imports. Transfers, both receipts and payments. Investments made by domestic residents abroad and by non-residents in India. Similarly, net banking capital, which means non-residents opening deposits here, your residents opening deposits in the rest of the world. Borrowings, the loans that you give to the rest of the world versus the loans that you are receiving from the rest of the world. Everything will be included under the balance of payments. I hope this part is clear. The next part is about exchange rates. In your NCERT, you will have one more scenario of what is called exchange rates. Now, how do we define exchange rate? Exchange rate, to think of it very simply, is nothing. It is just defined as the units of domestic currency required to buy 1 unit of foreign currency. How many units of domestic currency, our currency being rupee, how many rupees, from India's perspective, how many rupees will be required to buy 1 unit of any foreign currency? For example, as of now, $1 in India is closer to 90 rupees. This you are talking about is the exchange rate. You require 90 units of home currency to buy 1 unit of the currency of the United States. This is the exchange rate. You can also think of this as the price of foreign currency in the home economy. Can you also not think of exchange rate simply as what is the price of a dollar in India today? What is the price of the pound in India today? What is the price of a Japanese yen in India today? What's the price of the Chinese renminbi in India today? What's the price of 1 dirham in India today? The price of foreign currency in the home economy is what is also called exchange rates. Keep it very, very simple for yourself. The units of domestic currency required to buy 1 unit of foreign currency is how you define exchange rates. And if you can understand it here, you can clearly see that what is exchange rate? Nothing but the price of foreign currency in the economy. Today, if you have to buy a dollar, how many rupees is it going to take you to buy a dollar in India? Now, there are two mechanisms through which exchange rates are determined. One is called the fixed exchange rate mechanism. And the other one is also what is called the floating exchange rate mechanism. It is also called the market exchange rate mechanism. We'll start with the floating exchange rate mechanism or the market exchange rate mechanism. The simplest thing for you to understand is very simple. Think of it this way. If exchange rate can also be defined as the price of forex in the home economy, when the price of forex is being set by the market forces of demand and supply, this type of an exchange rate mechanism is called a floating exchange rate mechanism. Consider a very simple example. For example, if we have to talk about the price of dollar in India today, if the price of this commodity, of this dollar, is being decided by market forces, meaning if the price of this dollar is being defined, is being, you can say, derived through the market forces of demand and supply, then we are talking about the floating exchange rate mechanism. Meaning, come back to your demand supply model, the demand of dollars in the economy versus the supply of dollars in the economy. This is the demand of dollars, this is the supply of dollars, this is the price per dollar, and this is the quantity of dollars. The demand can increase, it can decrease. Similarly, the supply of dollars in an economy can increase or it can decrease. Think of it, what can create the demand? The demand of dollars versus the supply of dollars. Who will demand dollars or who will supply dollars? The demand for dollars could come from importers. Let us say you want to import a Tesla in India today. Musk would want to be paid in dollar terms. So you will demand dollars in India because you want to buy a Tesla from abroad. Importers, they can be importers of goods, importers of services. For example, when you are traveling abroad, when you are going to Europe, let's say for a vacation, you are importing a service. This is a service. Tourism is a service. Hospitality is a service. You going abroad, let's say you want to go to, let's say for that matter, France, you will require euros. Because you will require euros, you will create a demand for euros here in India. You will want to convert your rupee into euros before you go to France. You are creating a demand. You want to travel to the US for educational purposes, that again is a service. So you will want to convert your currency into dollars before you can secure an admission in the US and travel there. You are creating a demand. Importers of goods and services will create a demand. Similarly, domestic residents making investments abroad, offshore investments. For example, our healthcare player, Piramal, let us say they want to buy Abbott, which is a foreign firm. If they want to buy Abbott, they will have to buy the shares of Abbott, and the shares of Abbott will be expressed in foreign currency, and Piramal makes their money here in India in rupees. They'll have to convert their rupees into foreign currency before making any investments abroad. So they will create a demand. Outflow of foreign investments. When foreign investors want to take their money back, this is going to create a demand for foreign currency in the economy. Similarly, think from the side of borrowings. When you have to pay your debt obligations, you have received, let's say, Reliance took a loan of $1 million from the US. Reliance will have to return the $1 million as well as some interest in dollars back to US. When you have to make your debt obligations or pay your debt obligations back, you will require forex in the economy. Similarly, when non-resident deposits are seeing a withdrawal, when people who opened their bank accounts here in India, when they want to withdraw their money, this is going to create a demand. Or you can also think of you sending or giving loans abroad. When you are giving loans to the rest of the world, you will require dollars sometimes, right? All of this is going to create the demand. Where will the supply of foreign currency happen from? If importers create a demand, exporters of goods and services, they create a supply. Foreign investments. When Facebook wanted to invest in Jio in India, they are going to bring their dollars back to the economy. Similarly, when your domestic investments are being received, debt obligations, when you are taking loans, this could be external debt. External debt will include two things: sovereign external debt, that means when the government is taking a loan from external sources, or when the commercial entities are taking loans from the rest of the world. This is going to create a supply of foreign currency in an economy. Similarly, when you have non-resident deposits in domestic banks, this is going to bring foreign currency in an economy. When you get your loan repayments of loans granted, the loans that you had given to the rest of the world, when you receive the principal and the interest back, this is going to create a supply of forex into the economy also. These are the factors which will create the supply. These are the factors which will create the demand. When the demand and supply interact with each other, you will have a price. This price is what is called the exchange rate. And since this price is being decided through the market mechanism, through the market forces of demand and supply, therefore, this type of an exchange rate mechanism is also going to be called the market exchange rate mechanism or the floating exchange rate mechanism. Get this? Now, what can happen to demand? Demand can either increase or demand can even reduce. When demand increases in relation to the supply, what is going to happen to the price? The price is going to move up. When the demand reduces in relation to the supply, what is going to happen to the price? The price is going to reduce. Any increase in the price of foreign currency means that your currency is losing value. Let us say the equilibrium price was 50 rupees to a dollar. Because demand for dollars increased in comparison to the supply, the new exchange rate, let us say, was 100 rupees to a dollar. The price of dollars increased. The price of dollar is increasing, meaning that your rupee is becoming cheaper. Since your rupee is losing value, this is going to be called depreciation. An increase in the exchange rate means that the price of foreign currency is increasing. And the price of foreign currency is increasing in relation to your home currency. That means the foreign currency is gaining strength, your currency is losing strength. Since your currency is losing strength, therefore, this is going to be called depreciation. Similarly, if the demand had reduced in relation to the supply, the price of foreign currency in the economy will reduce. Let us say the new price comes out to be 40 rupees to a dollar. Since the price of foreign currency has reduced, you can say that the foreign currency is losing value, and it is losing value only because your currency is gaining value. Foreign currency becoming cheaper or becoming weaker means that domestic currency is becoming stronger. Therefore, any decrease in the exchange rate is going to be called appreciation, an increase in the strength of home currency. This is what is called the floating exchange rate mechanism, when the price of foreign currency is being decided through the market forces of demand and supply. What is the fixed exchange rate mechanism? It's very simple. Fixed exchange rate mechanism simply means when the price of foreign currency is decided not by the market forces of demand and supply, but by authority. And in our case, the authority would be the RBI. When we don't allow the market forces of demand and supply to decide what the price of foreign currency in the home economy be, this type of mechanism is called the fixed exchange rate mechanism, meaning that the authority is fixing the price of foreign currency in the economy. The price is not being decided on the basis of demand and supply, but on the basis of authority. This type of mechanism is called the fixed exchange rate mechanism. Now, what kind of a mechanism does India follow? India follows a mix of the two. This mix is what is called mixed float. You may also want to call it managed float. You may also want to call it dirty float. Typically, the words used are managed floating exchange rate system or dirty floating exchange rate system. What does this mean? It simply means that under normal circumstances, when there is nothing extraordinary happening in the economy, under normal circumstances, the exchange rate will be determined by the market forces of demand and supply. However, if there are extraordinary circumstances, meaning that if for some reason the exchange rate has become volatile, it is changing and changing ever so frequently. Either it is changing suddenly or it has changed very sharply. When this happens, in case of a sudden or a heavy depreciation or appreciation of the home currency, then the RBI will intervene and stabilize the exchange rate. Under extraordinary circumstances, RBI will enter and stabilize the exchange rate. This type of a system is why it is called the managed floating system. That means we don't allow the exchange rate to float as per the demand and supply of foreign currency in the economy. Sometimes we have to manage these exchange rates also. And when do we have to manage these exchange rates? In case of sharp or sudden appreciation or depreciation of the home currency. Only then will the RBI intervene to stabilize exchange rates. Otherwise, it's the market forces of demand and supply that are going to determine what the exchange rates in the economy will be. Now, this is the end of NCERT macroeconomics. Here onwards, whatever you have learned so far, you will have to apply this language to the subject which is called Indian economy. I hope these videos were very helpful for you. Keep your comments flowing. Your feedback is always appreciated. Thank you and best of luck.